Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host. I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoen here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
All right, Steve, let's jump into our first topic of the day. The Bank of Canada has decided to hold its overnight lending rate steady at 2.75%. This decision has left some real estate industry professionals a bit unsatisfied, as they were hoping for further cuts to help energize the market.
Yes, Sandy, especially since the central bank has already made significant cuts, reducing the rate by 225 basis points over the past year. That's quite a move, and it's almost on par with the Bank of New Zealand. However, it seems like the industry was expecting just a bit more.
Christopher Wine, Chief Operating Officer of Equiton, expressed disappointment, saying that an additional quarter-point cut could have helped build consumer confidence, which he believes is at a low point right now.
I can see where he's coming from. Confidence is crucial for economic activity, especially in real estate. But it's also important to note that the Bank of Canada is monitoring several factors, including U.S. trade policies and inflation data. They're trying to balance these elements carefully.
Absolutely, Steve. And with U.S. President Donald Trump threatening to increase tariffs on steel and aluminum, it adds another layer of complexity. This could affect Canada's economy significantly, as we're a major supplier of these metals to the U.S.
Exactly, and that uncertainty in trade can have ripple effects throughout the economy. It's a delicate situation. The Bank of Canada is expected to make its next decision on July 30th, so we'll see how things develop by then.
In the meantime, money markets and economists are still expecting at least 2 more rate cuts by the end of the year. Marcus and Millichap highlighted that further cuts could lower borrowing costs, benefiting those with variable rate mortgages and developers using shorter-term financing.
That's true, Sandy. But there's also the concern about inflation. Some of Canada's major banks are forecasting rising bond yields due to tariffs and potential government deficits. This could offset some of the benefits of lower rates.
Phil Soper, President and CEO of Royal LePage, mentioned that while inflation remains unpredictable, the Bank of Canada's focus seems to be on maintaining stability in the workforce, which is showing signs of softening.
Maintaining workforce stability is crucial, especially in uncertain times. It's a balancing act between keeping inflation under control and supporting a weakening economic outlook. Many potential buyers are understandably cautious right now.
Yes, and Royal Bank of Canada pointed out that the weakened workforce and cooling housing markets reduce the risk of surging prices if rates were lowered. However, they also noted that the data since April hasn't been entirely negative.
It's a mixed bag, Sandy. The Bank of Montreal also highlighted that inflation has picked up recently, which is concerning for policymakers. If it softens, it might open the door for a rate cut as soon as July.
Jordan Kemp from Greywood Developments shared that a rate cut could have helped the property market, especially in terms of pre-construction purchases, which have been affected by the current economic climate.
Indeed, Sandy. Kemp mentioned that development has been a game of inches lately, and while a rate cut won't change the outlook drastically, it's part of a broader context of uncertainty that affects consumer decisions.
With so many factors at play, it's certainly a challenging time for the real estate market. We'll have to keep a close watch on the central bank's next moves and how the economic landscape evolves. Let's talk about the recent data from the Canadian Bankers Association, Steve, which shows a concerning trend in the real estate market. The mortgage arrears rate has climbed again in August, reaching the highest level in nearly 4 years.
That's right, Sandy. The arrears rate is now at 0.24%, which is up by 1 basis point from the previous month and 4 basis points higher than last year. While these numbers might seem small, they actually represent a 20% growth in arrears, relative to total mortgages, which is significant.
Exactly, Steve. There are now 11,661 mortgages in arrears, which is an increase of 15.9% from last year. This indicates mounting credit stress among homeowners, and it's something that we need to keep an eye on.
It certainly is a red flag, Sandy. But what's even more concerning is the contraction in total mortgage volumes at banks. The number of mortgages held by Canadian Bankers Association member banks has declined by 1.7% from a year ago, dropping to 4.94 million in August.
Yes, and this isn't just a temporary dip. Mortgage counts peaked at 5.12 million back in June 2022 and have since fallen 3.5%, reaching the lowest level since October 2020. This sustained contraction is quite alarming.
The combination of rising arrears and a shrinking mortgage base points to a shift from household stress to market-level liquidity risk. Fewer new mortgages mean fewer buyers, which results in tighter liquidity. This could lead to a situation where the market can't absorb distress without triggering deeper losses.
It's indeed a challenging situation, Steve. Arrears are backward-looking, as they rise when homeowners can't sell fast enough to avoid default. With fewer buyers entering the market, the risk of not being able to absorb distress increases.
And that could amplify risk if investors realize that the exit is closing faster than expected. The current market dynamics are creating a cycle where credit stress and liquidity issues feed off each other, potentially leading to more severe economic consequences.
We'll have to watch how these trends develop, particularly as we approach the next Bank of Canada decision. These indicators are crucial for understanding the broader economic landscape and the potential impacts on both homeowners and investors. Steve, let's delve into the latest TransUnion report, which highlights some significant developments in the Canadian credit landscape. Total consumer debt in Canada has risen to $2.6 trillion, largely due to increased mortgage balances as interest rates have fallen. Mortgage originations have jumped by 18% year over year, as Canadians are opting for shorter-term fixed mortgages.
That's an interesting shift, Sandy. Historically, Canadians have preferred the stability of 5-year mortgage terms. But with the current high-rate environment, it seems many are choosing 1 or 3-year terms, hoping to secure better rates in the near future. This strategic move could potentially benefit borrowers if rates decrease further.
Indeed, Steve. However, even with these strategic moves, affordability remains a challenge, as the average new mortgage loan amount has increased to $359,623, up 4.1% from last year. This is particularly evident in Toronto and Vancouver, which continue to be among the least affordable markets in Canada.
And with average new mortgage amounts rising significantly in cities like Quebec City, Montreal, and Saskatoon, it's clear that affordability issues are not confined to just a few regions. The continued rise in loan sizes suggests that despite some easing in housing prices, the cost of entering the market remains high.
On the credit side, the report points out a widening financial disparity across regions. Early-stage delinquencies have declined, but late-stage delinquencies have risen, particularly in Ontario, Alberta, and Quebec. This indicates that while some consumers are managing to recover quickly, others are falling deeper into financial trouble.
That's right, Sandy. The rise in late-stage delinquencies could reflect the growing economic disparities and the uneven recovery across regions. For instance, Alberta has the highest delinquency rate, potentially driven by a high unemployment rate and the impact of tariffs on key industries like oil and gas.
And in Ontario, the increase in delinquency rates could be linked to a slowdown in manufacturing and the impact of tariffs on auto, steel, and aluminum sectors. These economic pressures are creating a challenging environment for many households.
Meanwhile, the credit card market is showing signs of a slowdown, with originations down 8.6% year over year. Lenders are becoming more cautious, focusing on lower-risk acquisition strategies, which might be a reaction to the current economic uncertainties.
Yes, Steve. Even though credit card originations have declined, average new card limits have increased, suggesting that lenders are selectively targeting more creditworthy consumers. This shift could be a way to mitigate risk while still maintaining growth.
The report also highlights some positive signs, such as the stability in early-stage delinquency rates and improvements among subprime cardholders. These trends suggest that some segments of the population are starting to recover, despite the broader economic challenges.
It's a complex landscape, Steve. While there are signs of stabilization, the overall picture remains mixed, with ongoing economic pressures and regional disparities. It's crucial for both consumers and lenders to navigate these challenges carefully. Steve, the Financial Services Regulatory Authority of Ontario, or FSRA, has issued some significant warnings about risks in the private mortgage market. They're pointing out that volatile market conditions might push more consumers back to private mortgages, and they believe stronger oversight is needed urgently. What's your take on this?
Sandy, FSRA's concerns make a lot of sense given the current economic climate. They've highlighted that borrower vulnerability is on the rise, and weak condo presales, coupled with tariff uncertainties, could increase demand for private mortgages. This scenario calls for more stringent supervision.
That's right, Steve. FSRA's 2025 to 2026 supervision plan emphasizes the need for private brokering and mortgage administration to demonstrate stronger oversight. They want brokerages to ensure proper supervision, disclosure, and documented exit strategies for clients. It's clear they are taking a proactive approach.
Exactly, Sandy. The delinquency rates have been climbing, particularly in Ontario. Toronto's mortgage delinquency rate hit 0.24% in the first quarter, and the province-wide 90-day plus arrears rate increased to 0.27% in the second quarter. These rising figures are a clear indicator of potential future mortgage payment difficulties.
And non-mortgage delinquencies are rising too, which is often a precursor to mortgage payment issues. FSRA is concerned about investor distress, especially with condo investors who bought at peak prices in 2024 facing potential capital losses.
FSRA is expanding its supervision because the private lending sector, while essential for those who don't qualify for traditional loans, is more susceptible to consumer and investor harm in the current environment. Their APR blitz found significant issues with disclosure practices in private deals, which is alarming.
Yes, during the APR blitz, they found that just 35.5% of files had correct annual percentage rate calculations. There were issues like omitted charges, APRs being too high on short-term mortgages, and incorrect inclusion of costs. These discrepancies can significantly impact borrowers.
And let's not forget the issues with mortgage administrators. FSRA found trust account deficiencies and commingling of funds among some administrators. These are serious concerns that need addressing to protect both consumers and investors.
Looking ahead, FSRA plans to focus on private mortgage suitability, disclosure, and exit strategies. They'll also be reviewing conflict of interest situations and expanding oversight to brokerages with over 100 agents. It's a comprehensive approach to tackle the vulnerabilities in the sector.
That's true, Sandy. Trust in the sector has improved since 2022, but the number of consumers who identify as vulnerable has also increased from 22% to 39%. FSRA's emphasis on consumer protection is timely and necessary given these statistics.
Despite significant price drops in major Canadian cities, first-time homebuyers aren't rushing into the market, Steve. In Toronto, the MLS Home Price Index composite benchmark fell by 5% last month, and average selling prices were down 7.2% year over year. Yet sales activity remains low compared to last year, with no signs of a resurgence.
That's right, Sandy. Even in Vancouver, where the HPI composite benchmark slipped by 3.4% compared to October 2024, the market remains sluggish. It seems that while prices are dropping, they haven't fallen enough to make homeownership feasible for many young professionals.
Mickey Kaneka from DLC Clear Trust highlighted that even with falling prices and interest rate cuts by the Bank of Canada, affordability remains a major challenge. The stress test keeps payments high, especially for single individuals earning between $60,000 and $90,000.
It's a significant barrier, Sandy. The economic uncertainty, particularly with the ongoing trade war initiated by U.S. President Donald Trump, adds to the hesitation among potential buyers. Kaneka pointed out that many are still on the sidelines, waiting for more stability in the market.
The Toronto condo market is particularly concerning, with prices plunging and buyers often facing substantial losses at closing. Even in Vancouver, presale buyers are encountering challenges with appraisals coming in below the agreed prices, which adds to the cautious sentiment.
That's a tough situation for first-time buyers. The Canada Mortgage and Housing Corporation believes it could take years to balance the oversupply in the condo market. Plus, there's no sign of a trade deal between the US and Canada, despite ongoing negotiations, which adds another layer of uncertainty.
Indeed, Steve, Kaneka mentioned that people are nervous about making big decisions in such uncertain times. The economic volatility and real estate market instability are at an all-time high, making it difficult for first-time buyers to feel confident about entering the market.
It's a challenging environment, Sandy. Until there's a clearer economic outlook and some resolution on the trade front, we might continue to see this hesitancy among first-time buyers. It's a wait-and-see situation for many, hoping for better conditions ahead.
The Greater Toronto Area's new home sales have hit a significant low, Steve. We're looking at 13 consecutive months of declining sales, with October seeing only 570 units sold. This marks a 29% drop from the previous year and a staggering 81% below the 10-year average of over 3,000 units.
That's a dramatic decline, Sandy. The numbers are telling us that the market is in a bit of a crisis. Single-family homes are leading this downturn, with only 322 sales in October, down 41% from the previous year. Condominiums, while slightly better, still saw a 2% year-over-year drop, with sales 88% below the 10-year average.
Edward Jeg from Altus Group mentioned that sales are happening only under very specific conditions and price points. He emphasized the need to bring costs back in line to encourage buyers to re-enter the market. It's a tough situation for end users, especially those interested in larger units, but the demand for smaller investor-owned condos is plummeting.
And the inventory situation isn't helping, Sandy. The remaining inventory reached an all-time high of 21,241 units in October, representing nearly a 2-year supply. With only one new single-family project launched, builders seem hesitant to start new developments in such an uncertain market.
The pricing trends are interesting, though. While the benchmark price for new condo apartments edged up 2.5% to over $1 million, single-family home prices fell by 7.4%. In Simcoe County, single-family homes averaged just over $1.1 million, with no condominiums moving at all.
BILD is calling for urgent government intervention. Justin Sherwood from BILD pointed out that the current federal measures, like the HST relief for first-time buyers, are too limited. There's a push for broader HST exemptions to boost the market.
The resale market isn't faring much better, Steve. The Toronto Regional Real Estate Board reported a 9.5% drop in total home sales in October, with the MLS Home Price Index benchmark falling 5% year over year. It seems like the entire region is struggling.
Absolutely, Sandy. With builder confidence waning and limited government action, mortgage professionals are feeling the pressure. They're caught between affordability gaps and the dwindling supply. Taz Zayed from Six Mortgage Group noted that appraisals for properties set to close are coming in lower than purchase prices from earlier this year.
It's a precarious situation, Steve. The building and renovation industry supports over 250,000 jobs and represents significant investment value. With home resales about 25% below pre-pandemic norms, according to RBC Economics, the economic impact could be substantial if conditions don't improve.
And it's not just Toronto, Sandy. Cities like Edmonton, Regina, and Winnipeg are also seeing declines, while places like Montreal and Calgary are experiencing modest upticks. RBC's analysis highlights economic uncertainty, job prospects, and immigration levels as factors influencing these trends.
Steve, let's dive into the latest report from the Fraser Institute, which paints a stark picture of the current housing affordability crisis in Ontario, especially in the Greater Toronto Area.
That's right, Sandy. According to the report, Families in the Greater Toronto Area are spending over 110% of their after-tax income on mortgage payments. This is a staggering figure that highlights the increasing financial strain on households.
It's quite alarming, Steve. Even outside of the GTA, in cities like Windsor and Kingston, families are spending more than half of their after-tax income on mortgages. The perception that housing outside the GTA is affordable seems to be misleading.
Exactly, Sandy. The report indicates that since 2014, the affordability of housing has significantly deteriorated. Back then, Toronto families needed 56% of their income for mortgage payments, and now it's over 110%. This shows how stagnant wages have not kept pace with skyrocketing home prices.
Co-author Austin Thompson pointed out that even though some might think housing is still affordable outside the GTA, the reality is quite different. Across Ontario, the housing unaffordability crisis has worsened due to stagnant wages and rising home prices.
And it's not just Ontario, Sandy. In British Columbia, especially in Vancouver, families are spending more than 60% of their after-tax income on mortgages. This has increased from 73.9% a decade ago to over 110% today, which is quite concerning.
Stephen Globerman, another co-author of the study, emphasized the need for policymakers to focus on increasing wages and incomes to address this issue. It's clear that without intervention, this trend might continue and worsen the affordability crisis.
That's a valid point, Sandy. In Atlantic Canada, the situation is slightly better, but still concerning. For instance, Halifax families are spending over half of their after-tax income on mortgages, which is a sharp decline in affordability.
And let's not forget the initial down payment, Steve. In 2014, it was roughly equivalent to 14.1 months of median after-tax income, but by 2023, it rose to 22 months. This increase of 56% adds another layer of difficulty for potential homebuyers.
Absolutely, Sandy. The report also mentions that no Canadian city has homes on the market that are affordable for families earning the local median after-tax income without a large down payment or external financial support. It's a tough landscape for buyers.
And as rent affordability declines, with median rent rising from 19.8% to 23.5% of median after-tax income, families are facing challenges on multiple fronts. It's a situation that requires immediate attention from policymakers.
Indeed, Sandy. The economic pressures are mounting, and without proactive measures, the housing market's affordability crisis could have long-term repercussions on the broader economy.
Well, that wraps up today's episode. We've covered quite a bit, from interest rates to the housing market's current challenges.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.